Good morning and welcome to the Illinois Advisor webinar, The Urgency of Estate Planning Today, How to Capture Available Benefits Before They're Gone, brought to you by the Illinois Soybean Checkoff. I'm Emily Carls and I will be moderating the webinar today. I want to thank you for taking time out of your busy schedules to join us this morning, and I have just a few housekeeping items to begin with. You can ask questions during the webinar by using the tools panel at the bottom of your screen, and we will have time for a Q&A at the end of the presentation. This presentation is being recorded and will be posted on the Checkoff funded website, ilsoyadvisor.com, along with a copy of the presentation slides. Without further delay, I'd like to introduce today's presenter, Kevin Beerley. Kevin is a tax attorney who partners with business owners to create sophisticated income and tax solutions that include structuring organizations, transitioning businesses, and maximizing tax benefits at present and into the future. Kevin routinely represents and resolves IRS appeals cases with an excellent track record of success. A detailed researcher, he creates solid strategies to protect business assets and limit risk. Kevin collaborates with both KCO ISOM and external resources to develop innovative solutions and employ creative tax techniques. His expertise resides in estate planning for family businesses with a focus in agriculture. Kevin, I'll hand it over to you now.
Thank you, Emily. Good morning, everyone, and thank you for joining us. We're going to kind of go through an outline of what you can expect me to talk about this morning. Obviously, this has become a hot topic as the new legislation has been proposed here over the spring, and Mr. Biden, President Biden, has now weighed in on what he would like to see happen. So I'll kind of go through a history over the next 45 minutes of how we got where we're at, where the estate tax system has become a political football in our country. I'll kind of go through that history so you understand where we're at right now and how we got there. And we'll talk a little bit about what the current estate and succession planning rules and laws are. And then we'll talk a little bit about that new legislation that has been proposed, both from the Republicans and the Democrats, and then obviously what the current administration is also proposing, and what they'd like to see in the near future and maybe even permanently. We haven't had permanent estate tax in quite a while for most people's lifetimes, so it'll be interesting to see how permanent they'll make this current legislation. We'll talk a little bit about the time frame associated with that, the likelihood of what will get passed and when. And then we'll talk about the solution, what our firm is seeing with our client base and with prospective clients that we meet with throughout the country, and what we talk with them about on how to solve their estate tax problem, their succession planning problem, because we are firm believers that the estate tax law should not drive your succession plan. Your succession plan should be designed around your wills, your wishes, how you want your family business to carry on. And so a plan should be put in place, not based upon what the estate tax laws are, but just because you want this family business to be able to continue to be productive and be available for the next generation and the generation after that. So we'll talk a little bit about that. So let's begin with where our estate tax system, how it even came into play. Our forefathers, as they came to this country in the 18th century, certainly contemplated a system that was different than the current system that they had imposed in Europe. It was basically the same 15 to 20 families that own most of the continent of Europe, because they just kept handing down the land base from one family member to another. And our forefathers, as they came over to this country, didn't want to see that same system. They wanted a meritocratic system where you had to earn by the sweat of your brow or your intellect everything that you got. So they certainly contemplated a system that wouldn't be inherited from generation to generation. Never put anything into legal binding. Obviously, it didn't make it into the Constitution. It was contemplated in the Federalist Papers, but again, nothing was ever enacted. And then during the Civil War, President Lincoln certainly attempted to enact some type of an estate taxing system to help pay for the Civil War. Nothing was made permanent. There was some trial balloons sent up, but nothing really became a fruition of that. Our current estate tax system actually was brought into existence during World War I, about the same time that our income tax system was. The estate and income tax system both came into existence around 1916, in essence, to help pay for World War I. And here we are 105 years later, and they both are still in existence. I like to tell people that, when they were first set up, our taxing system, income and estate tax, were both voluntary systems. And what that meant was that you had to actually raise your hand and file paperwork with the Treasury Department back then in order to pay any kind of annual income tax or estate tax. Our system became non-voluntary, and it is pretty all-encompassing ever since World War II, with withholding, W-2s, W-4s. So our income tax system really isn't voluntary anymore. If you don't believe me, try not paying your income taxes on an annual basis and see if the IRS doesn't eventually find wind of that and show up at your door. Our estate tax system is more voluntary, meaning that your personal representatives, your trustees, whoever represents you when you pass away, they have to, again, find a form, fill it out, and send it in saying that you were either over or under the estate tax exemption amount, whatever it was at your time of death, and volunteer to either pay taxes or not. So the estate tax system is a little bit more voluntary than the income tax system, but the IRS has a very long arm. They are aware of what most people own in this country through records, through deeds. And so I don't suggest that anybody really tempt the IRS on whether our system is voluntary or not. So the estate tax system, when it was created in 1916, the exemption amount per person at that point in time was $50,000 a person. So how did they get to that number? It was about 12 times the average household income. The average household income was a little over $4,000 in 1916. They multiplied that by 12 and decided the exemption per person should be $50,000. And it stayed $50,000 for the next 60 years. Up until 1976, the exemption per person was $50,000. And you're probably thinking, I imagine everybody paid estate tax during those years. No, nobody paid estate tax, because if you did very good planning right before you saw your priest on your deathbed, you would see your attorney and you would tell him to gift all of your assets away. There was no gift tax system during those years. So right before you passed away, you could gift an unlimited amount of assets to your heirs without ever paying any tax. And that's what most people with a small business, even a larger business, stocks, whatever, that's what they would do. They would just gift everything away. Well, in 1976, President Carter and the Congress decided to marry the estate and gift system to each other, and they doubled the exemption to $100,000 per person. So in 1976, the income tax system was separated completely from the estate tax system, and the estate tax system and the gift tax system became married together, in that you could either gift your assets away up to $100,000 during your life, or you could die with that amount of assets before you started paying a tax at 55%. So again, when the estate tax system started in 1916, the estate tax rate was 55%, and it was fairly flat. It got more graduated in the 60s. If you were worth more than the $50,000, or I'm sorry, if you were over $100,000, the estate tax rate went up to 65%. And if you were over $1.5 million, $2 million, it got up to 95% pretty quickly. So our estate tax rate got graduated up to a very high rate throughout the 60s. In 1976, it was lowered back to 55%, a flat rate on anything over $100,000 a person. So as we saw in the late 70s, and then really in the 80s, as the stock market started going up, the Reagan administration started ratcheting up the exemption amount. Throughout the 80s, we saw it get up to about $500,000 per person by 1990. And then it's continued to climb until about the mid 90s, where it kind of got stuck around $650,000, $675,000 for a while. So if you had a parent pass away in the 90s, that's what you're kind of used to, is that $650,000, $675,000 exemption per person, meaning that you could have that amount of assets before you were subject to the 55% tax rate. And if you remember, if you were in a small business, a family farm, you could use special use valuation to increase that $650,000 a little bit. And then by using a term called the qualified family owned business exemption, you could double that exemption to $1.3 million, With a special purpose, you could get close to a $2 million worth of exemption. So in the 90s, most farmers, even if their parents passed away, didn't pay a lot of estate tax because individually you had about a $2 million exemption if you use some of those tools, those strategies, before you had to pay the 55% rate. The problem with using those tools, the special purpose, the special valuation, and the qualified family-owned business, is the IRS put a lien on all of your assets, which made it hard to operate sometimes, and certainly made it hard to either sell assets or like-kind exchange them. So as a firm, we didn't use that strategy a lot because it frustrated our clients, it's frustrated the ag producers. But there were tools that were available starting in the 90s that we didn't have to use. That's qualified family-owned business tool and the strategy of special purpose. There other tools became available in the 90s that had been used since the 80s, but were certainly being ruled on in the tax courts more. Some of them are discounting in family business environments that a lot of families take advantage of, the discounting of assets, the use of certain trusts to do multiple generational planning. And we're going to talk about some of those things as to what we still see as available tools and strategies that work really well in the ag world, because the ag world is completely different than if you were sitting here with a manufacturing company, or if you just were sitting on a bunch of stocks in the stock market or bonds. Those kind of estate plans are a little different. Ag is a completely different animal and has to be treated differently in the estate and succession planning world. In the 2000s, as you remember, as Newt Gingrich and the Republicans took over Congress in the late 90s, and then in 2000, when Bush 43 was elected, they started putting the term death taxes on the estate tax. And it got very hard for anybody to vote for death taxes. It has a moniker just like Darth Vader, that's something you want to get rid of, right? So death taxes became the new symbol for estate taxes, and Bush 43 said he was going to repeal them. And in our Senate, you have to, in order to repeal or enact legislation and beat the filibuster rules, you need 60 votes. And the Republicans didn't have those 60 votes in 2000, 2001, and 2002 as they were passing their legislation. So if you remember, between Christmas and New Year's of 2001, their legislation got passed allowing the exemption to increase by about $1 million a year. It slowly started ratcheting up 1 million, 2.5, 3.5 is where we got to in 2009. And that was based upon the budget reconciliation. They didn't have to go through filibuster with that. So through budget reconciliation, they were able to keep increasing the exemption without having to have that 60th vote. Well, in 2005, the summer of 2005, an independent senator from Maine said, I'm going to vote with the Republicans on this. This estate tax system is too complicated. It keeps changing every year. I'm going to vote with the Republicans to repeal the estate tax. And that was in late August of 2005. Well, they never brought that legislation to the floor because Katrina hit that weekend. Congress and the president realized that taxes were going to have to pay to repair New Orleans. And so they never brought that legislation to the floor. And so we never voted on permanently repealing estate tax. And it wouldn't matter because the next administration can always unrepeal it. So repealing estate tax just means it lasts for as long as that administration is in effect. They never voted on that. So if you remember in 2008, when Obama won, the estate tax law was set up to be 3.5 million in 2009, 0 in 2010, and then it was set to go back to 1 million in 2011. And the best minds in the business thought we were certainly going back to 1 million because the Democrats could blame that on the Republicans because they're the ones that put that in place. And that's where a lot of people thought we were going. Either that or you did really good estate planning in 2010, and died. If you remember, that's the year George Steinbrenner died because he was worth, in theory, about $1.2 billion, and his kids were going to have to write a over $600 million check to the IRS. Amazingly, he died during that last week of December, and so his family didn't have to write that check. But everybody thought we were headed back to a $1 million exemption, and they were telling you or your parents to start gifting away a lot of assets. We certainly weren't recommending that strategy. We were aware that President Obama really wanted to pass his healthcare reform, and he needed the Republicans not to create a filibuster problem so that he could get it through the Senate. He thought he had an agreement with the Republican Senate that they would not challenge his Obamacare, and he would give a $5 million estate tax exemption to each individual. And that's what happened between Christmas and New Year's of December 2009, is that Obama allowed the exemption to go to $5 million per person, but the Republicans didn't filibuster his Obamacare. So he felt like that was a pretty good strategy, a pretty good compromise. All of us were fairly surprised that he was willing to go to 5 million, but he felt like he got his health care, and so he was pretty happy with that. On January 2nd of 2010, the Attorney General of South Carolina filed a lawsuit in federal court trying to overturn Obamacare. The next day, the Attorney General of North Carolina also filed a lawsuit trying to overturn Obamacare. That made Mr. Obama a little mad, so he, in his next budget 2 weeks later, proposed going back to $3.5 million exemption per person with the estate tax system. So he decided that he was going to roll it back. Well, he didn't have the votes to do that, and he never has, but every year from 2010 on, in his budget, he proposed rolling the exemption for estate tax purposes to $3.5 million and raising the tax rates back up to 55%. Under Bush 43, the tax rates were lowered to 40. They graduated up to 45 and 50 for a year or two. But for the rest of Obama's administration, the exemption stayed at 5 million, graduated for inflation, and the tax rate, the estate tax rate, was 45%. Everybody thought Hillary was going to win, and she was in Obama's corner in saying that I want the exemption to roll back to $3.5 million also. So in 2016, if Hillary was going to win, we all thought the exemption was going back to 3.5 per person, and the tax rate was going to be somewhere between 45 and 55%. They never really did land on a specific tax rate, but that was the best guessing coming out of her camp, that the tax rate was going to be somewhere between 45 and 55%. President Trump, interestingly enough, our candidate Trump at that time, was saying that he didn't like the estate tax system at all, wasn't necessarily proposing repealing it, but he was hearing that Canada didn't have an estate tax system. They don't. They have an inheritance tax system. And so he liked the idea of eliminating the estate tax system by using the Canadian system, until somebody told him what the Canadian system was. The Canadian system is, and we're going to talk about this a little bit more in a few minutes because it's under the proposed legislation. The Canadian system basically says, when you pass away, the difference between your adjusted basis in your assets and the current fair market value at death, that gain has to be recognized right away upon death. No step up in basis. You pay gain, depending on what the tax rate is, between the difference between your basis and fair market value at death. So once someone explained that to President Trump as he became president, he realized he didn't want that system anymore. He never really pushed for repeal of estate tax, but he certainly planned on adjusting the exemption amount. And as we saw the tax rules and the tax legislation being proposed throughout the fall of 2017, we saw that a compromise was taking place. And again, between Christmas and New Year's of 2017, we all received the Christmas present from President Trump's administration, where the exemption was doubled to 10 million, from 5 to 10 million. And then you took into consideration the average adjusted inflation, which got us up to almost $11 million of exemption pretty quickly in 2017 and 18. And that's where we are today, is based on that $10 million exemption that was put into effect in 2017, adjusted for inflation. Everybody on this call has an $11.7 million estate tax exemption for 2021, in that you don't pay any estate tax until you're over that amount in assets, equity, because you get to minus out your liabilities. So it has to be equity of in excess of 11.7 million, tax rate of 40%. So this is the best the estate tax system has ever been. Obviously, much better than the 50,000 we had per person, and much better than the 5 million it was at 4 years ago. This estate tax system allows you either, it's still married to the gift tax system, so you can either die without amount of assets, or you can gift it during your lifetime, or a combination of both. And if you're married, you just double the 11.7 and you get to the 23.4. And we have the ability that if dad dies first and we don't use up the full 11.7, anything extra can carry over to the surviving spouse. So not a bad time to be married, right? I mean, a spouse is worth at least $11.7 million to you right now. The problem with that legislation as it was passed in 2017 is that it also had to sunset. The Republicans knew they couldn't pass the filibuster rules of the Senate, so they added it to the Budget Reconciliation Act, and which meant that it couldn't blow up the budget over the next 10 years and that it had to sunset. So our current estate tax exemption and all of the laws under the current estate tax plan at the beginning of 2026 will roll back to the 2010, 2011 rules, which were $5 million per person, 45% tax rate, in theory adjusted for inflation, which would hopefully in 2026 put aside a little over $6 million of exemption a person. The adjusted for inflation isn't automatic. It would have to be accepted again, but everybody is aware that the exemption under law, the current law, has to roll back to the $5 million per person beginning January 1st, 2026. Between now and then, we have another election. We had an election last year. The Democrats took power in the House, and in theory have a one vote majority also in the Senate. We have an election in 2022 that will also augment our current system to determine who's going to be more in control. And then we have another presidential election and an entire House election in 2024 that will determine whether this legislation will be sunsetted by operation or it will change even sooner. So that said, we've already had proposals this year to change the legislation sooner than later. But the key thing to remember is this legislation has to change automatically at the latest January 1st, 2026, if not before then. So when President Biden was running for office, he talked a lot about a $3.5 million exemption. He also talked about a $5 million exemption. When he was vice president for Obama, he certainly was part of that reconciliation that got us to a $5 million exemption per person. But he also was a little upset at the Republicans, as Obama was, when they tried to overturn the healthcare plan, and he was okay with rolling it back to 3.5, and also when Hillary ran. So he's kind of fluctuated between the is it 5 million or is it 3.5 million? We heard a lot from Bernie Sanders' camp about a much higher tax rate, a state tax rate at a much lower level, and we finally got that legislation. So where do we stand currently? The STEP legislation came out first. We saw it being worked on in late March of this year, once we started getting past some of the COVID issues and problems and that COVID money rolled out. We saw Bernie and the really liberal side of the Democratic camp in the Senate start drafting legislation. So we're talking about Elizabeth Warren, Booker, Bernie. And so they started drafting this legislation, and it finally came out in a format that was a proposed legislation in April of this year. And again, it's called the STEP legislation. It stands for Sensible Taxation and Equity Promotion. I'm not sure it's any of those four things, but it certainly is now, it's not, I wouldn't call it out of committee because it hasn't been voted on, but the legislation has been drafted, it's been proposed. You can read it, it's on Google, it's on the internet, and I would suggest that the reason you're probably on this call this morning is that you've seen, heard, or are aware of some aspects of it. And even though people keep talking about a $3.5 million exemption, this legislation really says there's only a $1 million exemption. What it really does is it lays out the Canadian plan. It basically says that at death, the difference between your adjusted basis in your assets, all of your assets, and the fair market value is automatically taxed at a capital gains rate. It uses the term capital gains, but we'll talk about where that comes from. And it says that on any asset after being exempted from the first $1 million of gain. So in essence, there's a $1 million estate tax exemption under this legislation. Also, it divorces the tax system, the gift tax system from the estate system, in that you can only gift up to $100,000 of that asset value during your lifetime. Then again, anything over $1 million per person would be taxed at, in theory, capital gains rates. The problem is they propose basically doubling the capital gains rates from the 20% to the 40%, plus Obamacare would put the capital gains rate somewhere in the 43 to 45%. So you'd almost have a 50% tax on anything over that $1 million exemption. The other issue is it really hasn't addressed whether all assets will be treated equally. We know what capital assets are, and they should receive capital gain treatment. But what about your equipment that has been depreciated? That depreciation recapture under current income tax rules has to pay ordinary rates. Inventory, crop has to pay in ordinary rates. So this legislation is not overly clear on whether those type of assets would still be subject to ordinary rates, or it would pay the capital gains rates, albeit at a higher rate. So worst case scenario, you die with this legislation enacted, it's $1 million exemption per person. Anything over that would be taxed at anything from ordinary to capital gains rates in the average of 40 to 50%. That is that's pretty restrictive succession planning opportunities. As soon as we heard about this legislation, we got on the call to our Congress people in the Midwest. We bought a lobbyist firm out of DC several years ago, and we started telling them, you've got to start getting in front of congressional people and telling them this legislation has to be dead on arrival, because it didn't have a carve out for small businesses or any businesses. So if they want to make sure that no small business, no ag business survives from generation to generation, pass this legislation, because it won't. There's no way your family can afford to pay 50% tax rates on all your assets over $1 million or $2 million if you're married, and have to write a check to the IRS and then expect to be able to survive with a family business intact. So we were pretty adamant that there had to be a carve out for qualified businesses, or this legislation needed to talk about a much higher exemption. So it's interesting that shortly thereafter, as we rolled into late May, President Biden gave directions to the IRS that basically said the same thing that this legislation did, which is the spread between your adjusted basis and fair market value is taxable at death with a $1 million exemption. So even though he's talked about a $3.5 to $5 million exemption, under Biden's plan or his guidance to the IRS, that exemption would roll back to $1 million also. And he talked about using capital gains rates, but again, raising those capital gains rates to more like 40%. So we got concerned that Biden's proposal, his guidance to the IRS, was starting to look a lot like Bernie's legislation, that step legislation. However, he did make a carve out in his guidance for qualified family-owned businesses, which we liked. So that's a good thing. The problem is it doesn't define it, or it doesn't talk about how much of it is exempt. So are we going to go back to the 1990s where we had a double? You got the double basically the 650,000 exemption for qualified family-owned businesses that gave us $1.3 million. Well, if we do that, if that's what they're going to do today, that only doubles that $1 million to $2 million, and for a married couple, $4 million. I suggest most farming businesses, most qualified family-owned businesses would be over that $4 million. So even that wouldn't be enough. So under his guidance to the IRS, he doesn't define qualified family-owned business or talk about how much that exemption is. So we're going to have to parcel that out and see what kind of guidance we're going to get around that. So this is both scary legislation proposals that have come out. Bernie's, because it was being drafted in March, they were making it retroactive to January 1st, 2021, meaning that the planning you're doing this year would not even take effect. It wouldn't be legal because their legislation would be backdated to the first of this year. So I know there's attorneys telling people, we think the exemption's going back. Start giving away more of your 11.7 because there's no clawback provision that would cause things to be taxable if you give away more than that. So start giving more. Again, our firm's not recommending that strategy, but under Bernie's legislation, you wouldn't be able to do it because they want to backdate everything to the first of this year. Look, we're sitting in the middle of June. The odds of that getting made retroactive to January 1st, 2021 are very slim. There's not a lot of Democrats that are in the middle, and there certainly aren't any Republicans that are clamoring to sign on to this legislation. So we're not seeing a lot of people jumping on the bandwagon to get this passed. It was a starting point. Ironically enough, once they got that out there to the public, the Republicans in the House all of a sudden drafted legislation saying, yeah, we're going to repeal the estate tax. So you have these two extremes. You have Bernie's group in the Senate that is fairly extreme because everybody would be taxed after $1 million. You have the Republicans saying, yeah, we want to repeal estate tax again, which clearly they don't have the votes for or the stomach for. So we're going to have to compromise and meet somewhere in the middle. The fact that Biden's proposal and guidance is a lot closer to Bernie's is disturbing. The two good things that we see in that proposal is that it does use the term qualified businesses would be exempt, doesn't define it. The second thing I like is that it talks about it being enacted January 1st, 2022, which gives us time to do quite a bit of planning still this year. So that is the bad news and the good news. The better news is I don't really foresee any of this legislation getting enacted as such. Legislation that is drafted in the spring and summers of election cycle years never gets enacted the way the current administration wants it. There will be more noise around this as we enter the fall, especially once Congress comes back into session in September after Labor Day. You will see a lot more activity around compromise and what they're going to do around the estate tax planning. But quite honestly, if history is any guidance, the last three administrations have compromised and enacted estate planning legislation between Christmas and New Year's every single time. So that's realistically when it will finally get compromised, and we'll probably really know what it looks like. We'll have some better ideas this fall, but it's really probably going to come down to that last week of this year before we see anything that really gets passed by enough of a majority in the House and Senate to be enacted as legislation. I know President Biden tried to attach his tax bills to the infrastructure bill. That was dead on arrival from the Republicans' point of view. They are certainly compromising. Some of the Democrats and Republicans are compromising right now around the infrastructure bill, because I do think infrastructure is probably going to get passed at some point this year. There is a groundswell to create some of these jobs in communities. States are hurting for money, and so there is a push to pass infrastructure legislation. I don't see the tax bill being part of that because it couldn't get through the filibuster. There wouldn't be 60 senators that would vote for it. So there's probably going to have to be a compromise around budget reconciliation late this year, meaning that the estate tax law will not be permanent either. It'll be enacted, but it won't be permanent. And the next administration will have a say in that. So I apologize that that's the way our estate tax system has been, that it's been basically a political football for every administration since Bush 43. I don't see that changing anytime soon. I don't know if we'll ever have permanent estate tax again, which doesn't bode well for how do you do estate and succession planning. I mean, that's the sad news is most people use that exemption amount to determine how sophisticated or how intricate their estate and succession plans were. I'm suggesting that's never been a good idea, and it still continues to be a bad idea, because what Congress and the president gives you, they can take away at any time. The next administration will certainly change the rules, and we could see huge shifts in I mean, our country is so structured around extremes on each side that it's hard to get anything bipartisan passed. We become partisan on every type of legislation you can imagine. So I think we could start seeing huge shifts in the exemptions from one administration to the next. The bad news is taxes are going to go up. Income taxes, estate taxes, they're all going to go up because of this because of the fact that we've given away over $3-4 trillion in the last 18 months, and they're trying to give away more money. So taxes are going to have to go up on anybody they consider wealthy, and to be an ag producer, you have to be wealthy these days to even function or be productive. So we do have to plan around that. You'll have to be in touch with your attorney or accountant through this late summer and fall just to see what they're seeing come out of Congress. Some of it's going to be scary, but I would suggest the scariest stuff most likely will not get passed. We will see some kind of compromise late this year, most likely. It could carry over one more year. They're so far apart, and I don't see anything in the middle that right now I would tell you they can't get anything passed. But cooler heads will prevail in the fall. They always do. And you'll start to see something congeal around that $3.5 to $5 million exemption. That's what the best minds in estate and succession planning are starting to gravitate towards, is that we'll see something around that $3.5 to $5 million exemption. Because the legislation is drafted, a lot of terms have to be identified. They have to be given a definition, and that just gives rooms for attorneys and accountants to, get creative, right? I mean, we're going to get creative. If this legislation passed, we get creative around it. It's hard to congeal votes around some of these terms. So the easiest thing to do is lower the exemption and raise the tax rate. And if they're looking for an easy solution as a compromise late this year, that's most likely what you're going to see, is some kind of compromise around a lower exemption and a higher tax rate. So what do you do about that? What do you do when you're in an environment where the estate tax law, the succession rules are changing every year? They will continue to change. And yet you want to make sure that this family business carries on, whether it's a Democratic or a Republican legislation. Well, we've been telling people for years that the best thing you can do in your estate plan is obviously have a plan. Because if you don't have a plan, if you're waiting for the laws to be perfect for you, or you think that I'm under the exemption so I don't need a plan, believe me, a judge, an attorney, or the IRS will determine a plan for you. If you don't have a plan, a judge, an attorney, or the IRS will, because at some point your family will disagree on what your plan is, and they will run to an attorney, which means judges are going to decide how to interpret what your plan is. And if you're over the exemption when you pass away, the IRS is going to have a big say in what your plan is, because assets are going to have to be sold. Liens are going to be put on them, which really limits the ability of your family members to function. So have a plan in place. And the smartest thing you can do is have a plan and then communicate it to your kids. I don't care how well your kids get along. They are interpreting what you want to happen with a family business differently. People are different. And once they get married, their spouses will interpret what you want differently. So you don't have to give your kids all of the details of your plan, financial or whatever, but at least communicate to your children, your grandchildren, your heirs, that you have a plan and this is what you would like to see happen. And then the best thing you can do is separate your operations from the land base. If you keep all of your operations and land base in the same entity structure, when you pass away, eventually there will be an heir that isn't on the farm, and they are going to want something different than the operators. And they're going to think they have a say in that. And so if they're living in a $200,000 house and haven't been on vacation in 3 years, and the son's back on the farm and he's buying a combine every 3 or 4 years for $500,000, that off-farm heir is eventually going to talk to their spouse and say, hey, this doesn't seem fair or right. So do not have the off-farm heirs making decisions with the on-farm heirs. Separate the land base from the operations so that the operators can operate the farm the way they see fit and don't have to get permission from the off-farm heirs. I see this mistake time and time again, and the only way to resolve it is usually to bring in attorneys. And I don't like that, because attorneys will bill until all the assets are gone and then they walk away. So please separate your operations from the land base. Everybody can benefit from the land base. It's basically, once you're gone, it's basically a rent check or a dividend that goes out, and you can determine what that percentage is. You want to keep a lot of the the equity in the operations coming back to the operations so that the on-farm heirs can succeed. But there has to be a minimal distribution made to those off-farm heirs so they feel like they're getting something from mom and dad also. So we spend a lot of time talking through that process. And then what we recommend is putting that land base in an entity that can still be discounted. An LLC, a corporation, an S Corp, any of those type of entities in Illinois can be discounted. The tax courts are allowing usually around a 40% discount. So we like to see the land base put in that entity structure for protection purposes. Another reason is because there's an operating agreement that will be put in place that you guys can change. I mean, most people are young enough, they don't want to do permanent estate planning, but they do want to do estate planning that will have effect. So by having that operating agreement, if you see a change in the future, you can always change that operating agreement based upon your family dynamic. So put the land base in that entity that can be discounted 40%. Because remember, President Obama, the tax courts have been asking him for years, tell us what these discounts should be, because the tax court spends a lot of time determining what family discounts should be when family members die and estate tax returns have to be filed. Finally, President Obama said, I'm going to tell you, the estate tax or the discount exemption for family-owned businesses where all the interests are owned by a family, the discount's zero. So he asked his treasury to enact that in 2016. And Hillary Clinton, when she was running, was going to have that become law. Obviously, and President Trump said, yeah, I'm not going to put that legislation into effect. So it's still sitting out there. It has no effect yet, but we do know that there are Democrats and certainly President Biden that feels like discounting assets in a family-owned environment probably isn't something that they're going to want to see going forward. So how do you take advantage of that if they're going to take that away from that? The way to do that is we like to use trust environments. So there's only two types of trust. Irrevocable trusts, which is exactly what it sounds like. Irrevocable, meaning you can't change it. You give up control, you give up cash flow. And if I asked you to put assets in there, you tell me I'm crazy. The other type of trust is a revocable trust. That's the type of trust you should have because it really lays out for your family where you want your assets to go when you pass away and how your debts get paid. So that really is a blueprint of how the family farm continues on for the next generation and the generation after that. So everybody with a family business should have a revocable trust, which means you can change it. The problem with it being revocable is that all of the assets in it are part of your estate and they're all subject to taxation. So wouldn't it be nice if there was something in between, a trust that you can control and a trust that got the assets out for estate and gift purposes? There is such a trust. It was created by an ex-IRS agent in 1979, and the tax courts have been ruling on them for the last 40 years. They recognize them. It's called an intentionally defective irrevocable trust, an intentionally defective irrevocable or grantor trust. These have the best of both worlds. So if you have your land base and you move that asset at a discount because it's in an LLC into this trust, it is outside of your estate and gift for estate and gift purposes. So it can continue to grow over the next 40, 50, 60, and Illinois can go on for about 100 years in this trust and nobody pays estate tax on it. You don't, your kids don't, your grandkids don't. So it can stay in this environment and continue to grow. And these things are very powerful. We've put these in place 30 years ago. We go back and meet with families that have seen their land values quadruple in 40 years. And they are very, very happy with how this works. So you get your land base out of your estate so it's not subject to taxation. It can continue to grow. Because it's in an LLC that you operate, you continue to control it through the operating entity. In essence, what we usually do is move the non-voting units. So when you set up that LLC, it'll be 99% non-voting, 1% voting, and you'll move the 99% non-voting because they're the discounted ones. You can discount non-voting by about the 40%. You move those into that trust, you keep the voting interest, you control that entity until the day you die, and then you determine which heir, usually one of your operating heirs, gets that 1% voting. And if you have more than one operating heir, they each get a 0.5% or a 1/3%. You can break that up so that the operators are still in control. That trust, when you pass away, when you and your spouse pass away, then splits into separate shares, one for each kid, so that they don't have to deal with each other. They each get their own share. of that land, not the land itself, but each share of the operating entity that owns the land. And they can be their own trustees, so they can determine when they want to make distributions to themselves, and how they want their trust to then go on. The worst thing you can do is tie your family members all together for forever in perpetuity. They will eventually end up fighting. That's why that operating agreement, that land entity, also has to have a buy-sell. All of your entities need buy-sell agreements, because if you don't put in place how family members get in and out of the family business, again, attorneys and judges will make that determination, and I see that all the time. You have to have buy-sells in place, telling people how they get out of the family business and how other members get in. Because invariably somebody's going to want out, and if the agreement itself doesn't say how they get out, they will run to an attorney who will ask a judge to determine how they get out. And if they're getting out of the land entity and the judge says, pay them 100% of their value right now, that will put a real restriction on the operations. So usually that buy-sell in the land entity also discounts getting out. You usually use a 30 or 40% discount. If you want out of the family business, you're taking a discount and you're not getting paid out right away. You're getting paid out over 15 or 20 years, so that you think really long and hard about, do I want to still keep getting that rent dividend check every year that brother's giving me? Or do I want to get paid out over the next 50 or 20 years at a discount? We want most family members to stay in these family operations, because then they benefit the next generation also. But there's situations where it makes sense for family members to get out, and they have to have an access for being able to get out. So please make sure that all of your entities, whether they're operating entities or the land base, has good buy-sells in place, and please update them every 10 years. Judges like to say that buy-sells that are older than 15, 20 years are not material or have no effect anymore. So make sure your buy-sells reflect what you really want, because you can change them, and make sure that they reflect market situations. So please keep updating those. So the last thing I'm going to talk about before we take questions is the best way to get those limited non-voting interests into this trust is to gift a small amount, because you want to get your statute of limitations running right now. If you're over the exemption when you pass away, whether that exemption is 10 million, 11.7, or 1 million, if you're over that exemption, you have assets, equity over that amount, the IRS has to audit your estate tax return. You do not want to put your family through that headache. The IRS is fighting for every dollar, and their statutes it says we can use highest and best use. So if they think there's going to be solar panels on your property, if they think there's oil under your property, if they think there's going to be turbines, if they think your property, your farm could be developed, that's what they're going to want to value it at. Your children are not going to want to value it at that. Don't let them get into that fight with the IRS when you pass away, because it takes about 2 years to get through that process. It's expensive. The IRS always wins something, and they have to hire people like me to take them through that process. And the IRS puts a lien on everything until they get paid. So file a gift tax return now with a small amount of those non-voting interests of the LLC, land LLC, into this IDIT. Get this statute running now. Basically say to the IRS, you have 3 years from now to audit me. And if you don't, and they won't, because again, you're making a very small gift, you have an $11.7 million exemption right now, and the IRS is going to see more gift tax returns this year than they've ever seen in their life, because everybody that owns a business is doing good estate and succession planning this year. So they're going to see very many gift tax returns. In general, 1% of gift tax returns are audited a year. It's going to be 0.5% this year. So file a gift tax return, make sure your accountant or attorney does. File that gift tax return, get the statute running now so that when you pass away, they can't audit your estate return. Then sell the rest of those units, those non-voting units that are discounted, sell the rest of them into that trust. While you're alive, that trust is a grantor trust. So that sale is not recognized by the IRS. In essence, you're selling it to yourself, is what the tax court has said. So it's not a recognizable event for income tax purposes, but for estate and gift tax purposes, you've now invoked Illinois state law because you've created a contract under that sale. So when the next administration changes the estate tax law, when the administration after that, they can't change your plan because you have invoked Illinois state contract law. Our Supreme Court has not overturned state contract law in any state in over 100 years, and they won't. President Obama realized that. He said, I can't undo plans that are in place. I don't want people using these trusts and discounting in the future. This is still the most powerful tool out there. Under Bernie's plan, we couldn't even enact it this year. Bernie's plan's not going to be enacted most likely, but use these tools, because we are seeing the Democrats want to limit the ability to use these trusts, limit the ability to use discounting, and limit the ability for you as a family business owner, ag producer, to do really good estate and succession planning. Don't wait for the rules to get worse. Please take advantage of this. Talk to your accountant, talk to your attorney. If you're not comfortable, if you don't have one, I think our phone number, my direct line number is available. Please contact us and let's have a conversation and talk about how to solve your problem, and more importantly, meet your goals so that your family business can continue on for generations. Thank you. And let's see if we have any questions out there.
Yes, thank you, Kevin. There's definitely a lot of moving pieces to estate transition planning. So thank you for all of your insight today. We do have a few questions that were submitted. I think you answered a couple of them. I might have you expand on those answers a little bit here. So one of the conversations we have often with farm heirs specifically is fair versus equal. And this one kind of talks about tools that are available to make it fair to everybody, with a little bit of a twist on it, specifically with special needs children or grandchildren. Is there anything specific with that piece that you would recommend for people to use?
Yeah, so let's talk about fair and equal real quickly. Is in the farming community and any business, the person that stays back and operates it should get the benefit, because they're making the person that isn't part of the business, they're actually creating equity and cash flow for them. So we always have this conversation and say, yes, whoever's willing to sacrifice and stay back should get something additional, because they're making it possible for the off-farm person to receive that rent or dividend check and continue to be part of the family operations. So if you really want to enhance what the off-farm heir is getting even more, maybe that's room where life insurance makes sense. So I'm not a big fan of life insurance because you never know how much you need or want, and you can't afford it when you do. But sometimes that is the right answer, is having a life insurance policy for those off-farm heirs. For the special needs part, the nice thing about these IDITs and your revocable trust is you can carve out a section where that special needs person gets their own separate share, and they are not allowed to be their own trustee. And so as long as there's an independent trustee to determine that no assets other than the government mandated amount go to that trust for the benefit of that beneficiary, then they can qualify for the Medicare, Medicaid, whatever you need them to under your state mandates and the federal mandates. So creating either a revocable trust and or that IDIT allows you to carve out a separate share for that special needs person that will allow it to qualify for federal and state supplements. So each state is different on that. So again, each state has their own attorneys that knows those rules. Make sure you have those conversations, but that is certainly available. Great question.
Perfect, thank you. Another one has to do with the step up in basis. So I know you said there probably wouldn't be a whole lot of movement on the legislation until the fall, and we all know that step up in basis is a powerful tool for ag producers. So this question is, in your opinion, what's the likelihood of that step up in basis going away? And maybe you don't have a good feel for that yet since it's so early, but there's a question regarding that.
It's a great question because it's talked about more, right? I mean, even Mr. Trump, when he was running for Congress for president, for some reason he got in his head that Canadian system was a good answer. And most countries use that system. So that's why it's talked about more by our Congress. So the conversation's not going away, but it creates a real problem for family businesses, right? Europe, Canada doesn't have the same family business structure necessarily that the United States does. So I don't think there's a strong likelihood that it passes, or there'll be a carve out, i.e. an exemption for small businesses, qualified businesses, however they define that, that the European systems and the Canadian systems don't have. The bad news is you're going to hear about it a lot for the rest of your life because most countries have this type of system. Our Congress is going to talk about it. The Democrats are certainly going to try to keep enacting it. Well, they don't have the votes this year. I can't tell you in 2 or 4 years that they won't have the votes, but they don't have the votes this year. So the likelihood of losing the step up in basis this year isn't high. The other thing I will tell you is this country is never going to be dependent on another country for food. It's just not going to allow it to happen. So to that extent, ag is going to get some kind of carve out eventually. We are not going to ever allow you and your spouse to pass away and all of a sudden the kids have to sell off the entire family farm in parcels because nobody knows if that farm will then be farmed again. And we need every farm in this country being farmed for the foreseeable future. That won't always be true, but for the foreseeable future, ag will get a carve out.
Perfect. Thank you. And just kind of one wrap up. I don't know if this is a question so much as just kind of final thoughts from you. There's a lot of information out there on this new legislation, a lot of pieces that people are reading. So what's just kind of a final parting thought you would give everybody here just on the legislation and just a piece of advice that you could leave everybody with?
Yeah, so don't ruin your summer by reading every legislation that comes out. Okay, this is like right before the election. Don't read everything you say about everybody. Anybody can blog. Anybody can say that they think this legislation should do that. In fact, a lot of people are paid to do that. Understand they have agendas. We've never seen a state tax legislation pass in the summer. We've never seen it pass in the fall. It always is in the wintertime unless it can get attached to a specific piece of legislation. Bernie's proposal under the step has no chance of getting attached to any of the current legislation. What I would recommend is enjoy your summer, take a vacation. You all deserve one. Go enjoy yourself and then replug in after Labor Day. That's when some of this will start heating up a little bit more. Call your attorney, call your accountants, call us, call whoever you trust, and just ask them what they're seeing as you start getting into harvest. Well, you know, you're sitting on a combine that basically runs itself. So you have time to make some phone calls once in a while and just check in with people and see what they're hearing or saying. But please don't ruin your summer by reading every piece or every blog that comes out concerning legislation. 99% of it won't even come out of committee and it'll never get voted on. So don't ruin your summer looking at it, and have a great summer.
Perfect. Thank you so much for your time today, Kevin, and your insights on this legislation. So that includes our webinar for today. If you could take a few minutes after the webinar to answer the post-event survey, that would be great. The next Illinois Soy Advisor webinar will be on July 22nd. You can register for that event or view the recording of the presentation and other soybean and agronomic resources on the checkoff funded website, illsoyadvisor.com. Thank you so much for attending today and have a great day.